In this video, I'm going to cover an alternate version of problem 1-7, the first two parts. Additional videos are going to cover the financial statements. Just to set up the problem, the owner, Gabby Graham, is going to start a consulting business, Graham Company, on May the 1st and encounter a variety of activities in the month of May. Our goal is to record the effect these activities have on the company's accounting equation, its assets equal liabilities plus equity. A point to stress here is we're recording this from the effect of the business Graham Company, not its owner, Gabby Graham. Like most businesses, Graham Company finds it helpful to understand the impact on specific types of assets, specific types of liabilities, and specific types of equity in order to have more information to run its business. So for Graham Company, its assets include cash, or the money available to pay for supplies, to buy equipment, to pay its employees. Accounts receivable, that's amounts owed from its customers. That's an IOU to Graham Company from its customers. And office equipment, so perhaps that's a desk or a computer that the company uses to provide consulting services. Liabilities are debts or amounts owed to others. So an example of a liability for Graham Company is accounts payable. It sounds very much like accounts receivable, but accounts receivable is an amount owed to Graham Company from its customers, whereas accounts payable is an amount owed from Graham Company to its vendors or suppliers. So it's an IOU to someone else. Equity includes two major types. One of those major categories is what we call contributed capital, or what we know so far as common stock. That represents what the owner has specifically invested in the business. And for this company, that's what Gabby Graham has invested in the business. Then we have another major category, which is called retained earnings. That's the profit the company has earned from providing its consulting services and hasn't paid out as a return to Gabby Graham, its owner. That includes three major categories: revenues or income that Graham Company earns from providing its services; expenses, its cost of doing business, those things it's used up or expired; and dividends, the amount that Gabby Graham has returned, often in the form of cash, to its owner. Now, you may note that most of these items have pluses before them. And you have an exception with dividends and expenses because dividends and expenses take away equity from the business. For example, if Graham Company increases its dividends by providing cash to its owner, Gabby Graham, that's taking away retained earnings or equity from the business. So that's why you see a negative before that. Now that's enough for setup of the problem. Let's go ahead and jump in and start recording those transactions. Couple important things to keep in mind is that every single activity is going to affect at least two different types of accounts. And also, our accounting equation should always remain in balance. Assets equal liabilities plus equity. So on May the 1st, Gabby Graham's going to invest $44,000 in cash in the company in exchange for stock. Again, keep in mind, why I'm showing cash increasing is we're recording this from the perspective of Graham Company, and Graham Company's cash is increasing by $44,000. Now we're not done because two things haven't happened. We haven't recorded effect on a second account, which I said was necessary. Our accounting equation's also lopsided. We increased assets, but we didn't do anything on the right side to balance it out with liabilities and equity. The other part of this transaction is the ownership interest in the company is increasing, and we'll represent that by common stock. So we're also going to increase our common stock by 44,000. So our assets are 44,000 equal our liabilities of 0 plus our equity of 44,000, and we're happy our accounting equation is going to remain in balance. On May the 1st, also the company is going to rent a furnished office, and they're going to pay $2,300 cash for May's rent. So from the company's perspective, cash is going to decrease. So we see a subtraction of cash, that's why it's in brackets, of $2,300. And again, we've got to affect something else here. And the additional thing that we're going to affect is going to be expenses, because we're talking about rent. That space, we don't own the space. It's going to be used up in the month of May. we're increasing our expenses. Now, again, on the surface, you may say, this doesn't leave the accounting equation in balance because I have a subtraction of cash here, but in addition to expenses. But keep in mind, expenses subtract from equity. So ultimately, we have left the accounting equation in balance because if we looked at our equity overall, it would be our $44,000 in common stock minus our $2,300 in expenses, and that would balance out to our asset amount. On May the 3rd, the company is going to purchase $1,860 of office equipment on credit. So they're not saying we're paying cash. They're saying they have an IOU to their vendor or supplier. So one thing that's affected is office equipment. Office equipment is increasing by $1,860, so their assets are increasing by that amount. We can't decrease cash because they haven't yet paid it, but we are going to increase the IOU or amount owed to its vendors or suppliers, which we represent by accounts payable. Again, accounting equation still in balance. Assets have increased by $1,860, and liabilities on the right side of the equation have balanced out with an increase of $1,860. On May the 5th, the company is going to pay $800 of cash for this month's cleaning services. Cash, once again, is going to decrease by $800. And since the cleaning services are used up in the month of May, it's not something that carries forward into the future. We have yet another expense. This time we're going to increase by $800, and this in particular is a cleaning expense. And again, it does leave the accounting equation in balance because expenses decrease its equity. On May the 8th, finally, the company is going to provide consulting services and it's going to collect cash immediately of $5,300. So cash is going to increase by $5,300 and the company has provided its services so its income or its revenues are going to balance out and increase by $5,300. On May the 12th, the company is also going to provide an additional $2,700 in consulting services. So again, its revenues are going to increase, this time by $2,700, but they're being provided on credit. So that's saying they didn't yet get cash. They got an IOU from their customers. What represents an IOU from our customers? Accounts receivable. So accounts receivable is going to increase by $2,700. Now you might have thought, wait a second, I probably shouldn't record the revenue until I receive the cash. But keep in mind those principles and assumptions of accounting include revenue recognition, and we need to record the revenue when we earned it. That might not be at the same time we receive cash, and if we don't receive cash immediately, we can record the IOU or increase accounts receivable. On May the 15th, the company is going to pay $730 cash for an assistant's salary for that first half of the month. So the employee has already worked, they're just paying them their salary. We're going to decrease Graham Company's cash by $730. And again, since the work has already been done in the past and used up, we're going to increase our expenses by $730. And in this case, it would be a salary expense. On the 20th, the company is finally going to receive that $2,700 cash payment for the services it provided on May the 12th. Keep in mind, we already recorded the revenue on May the 12th when Graham Company provided the service. So we don't record revenue again. We do show the increase to cash because the company is receiving cash of $2,700. Again, not impacting revenue again, but we need to subtract from or decrease accounts receivable because the customer no longer owes the company. Now, most of these transactions, we've had either an increase on one side and an increase on the right side, or a decrease on the left side and a decrease on the right side. And this looks like a bit of an anomaly that we're increasing and decreasing on the same side, which is fine. So here we're exchanging one type of an asset, our accounts receivable, for a different type of an asset, cash. Ultimately, we have a net zero impact to assets and a net zero impact on the right side of the accounting equation, so it still leaves things in balance. I'm going to go a little bit more quickly through the 22nd and 25th because they're very similar to what we just did. The company provides $3,900 of consulting services on credit. increasing revenue by 3,900, increasing accounts receivable by 3,900. On the 25th, the company receives $3,900 cash payment from those services just done on the 22nd. So cash is increasing by $3,900 and accounts receivable is decreasing by $3,900. Again, similar to just go back a couple transactions. On the 26th, the company is going to pay the $1,860 cash for the office equipment it previously purchased on the 3rd. If you go back to your earlier transactions on the 3rd, we had increased office equipment by $1,860 and we had increased accounts payable. Now the company is paying cash, so they're going to subtract cash of $1,860, not impacting office equipment because that was already done on May the 3rd, but they're going to decrease their outstanding IOU to that vendor or supplier by showing a subtraction to accounts payable because they're decreasing their debt by paying it off. On the 27th, the company is going to purchase $90 of advertising in this month's, which is May, local paper on credit. Cash payment isn't due until June 1st, so they're not going to pay until June. So we're not going to subtract from cash. We're going to increase the obligation or IOU to our vendors and suppliers by $90. So increasing accounts payable by $90. The advertising is going to be used up in the month of May, so we're also going to increase our expense, and it would be advertising expense by $90. Again, on the surface, it looks like two increases on the same side, which you might think would throw things off, but liabilities are increasing by 90, and ultimately equity is decreasing by 90 because expenses take away or subtract from equity. On the 28th, the company is again going to play that assistant, but this time for the second half of the month. So cash is going to decrease by $730 and expenses are going to increase by $730. And again, this would be salaries expense, very similar to our first payment to our assistant. On the 30th, the company is going to pay $300 cash. So we're going to show a subtraction of cash for this month's telephone bill. So it's all going to be used up in this month. So we're going to increase our telephone expense by $300. On the 30th, the company is going to pay $260. So decrease cash by $260 for this month, all used up in the month of May, utilities. So we're going to increase our utility expense, which again decreases our equity by $260. Finally, we're going to give a return to Gabby, our owner, to represent how thankful we are for that ownership interest. So the company is going to pay $1,800 cash and dividends to the owner, again, Gabby, which is the sole shareholder. So cash is going to decrease by $1,800. Again, we've got to leave things in balance. We're increasing our dividends. Increasing our dividends, that's a payment to our owners, which ultimately decreases our equity because it takes away equity from the business. Overall, before we finish off this first part, let's step back and take a look at this. If we add and subtract all the amounts that affect cash, we would end the month with a cash balance of $47,120. Accounts receivable, while we did have increases from amounts owed from our customers, they ultimately paid them off, so accounts receivable ends the month with a zero balance. Office equipment, the company ends with a balance of $1,860. Accounts payable, again, we did have an original amount we owed. We paid that off, but we still have that $90 that we owe for that advertising bill, so accounts payable is going to have a balance of $90. Common stock has the original investment of $44,000. Dividends has the one dividend of $1,800. Revenue, a few times they provide consulting services, add up to $11,900. And several different types of expenses throughout the month add up to $5,210. Just to make sure we consolidate this and prove out it balances, our assets, cash, $47,120 plus office equipment, $1,860, add up to assets of $48,980. Our liabilities are only $90, but our equity, if we take our common stock of $44,000 minus our dividends of $1,800, because dividends take away equity, plus our revenue of 11,900 minus our expenses of 5210. Again, expenses take away from equity. Our total equity is 48,890. 48,890 plus $90 in liabilities equals our assets of 48,980, and we are in balance. Our next video is going to get started with our financial statements.